Today I'll be looking at a major development that could significantly impact millions of retirees' financial situations, the potential elimination of taxes on Social Security benefits. Over my many years of helping clients optimize their retirement income, I've seen firsthand how Social Security taxation creates financial challenges for many retirees. These people are surprised to discover that their benefits are actually taxable when they get to retirement time. That's exactly why I'm making this video today, to explain the new legislation to you that could eliminate these taxes, who would benefit the most, and what this change might mean for both current and future retirees. Let's get right into it. One of the most significant financial surprises that catches retirees off guard is what I call the Social Security tax trap. This is where 40% of Social Security recipients discover that their benefits are subject to federal income tax, often creating an unexpected financial burden for them during retirement. This tax issue affects millions of Americans each and every year, causing them to keep less and less of their hard-earned money due to taxes. The income threshold that triggers these taxes is actually quite low. It's $25,000 per year for singles. This means that even modest income retirees can be caught in this horrible tax trap. These same middle income retirees can face substantial tax bills on their Social Security benefit, causing them to pay up to 45% of their Social Security benefit, causing that to be taxable. More and more people will be affected because the taxation thresholds, they've never been adjusted for inflation since 1983. This tax burden isn't just a mere inconvenience. It fundamentally changes the retirement math for millions of Americans through what amounts to be what I call double taxation for you on your Social Security benefit. Here's what I mean by this. During your working years, you pay FICA taxes from your paycheck on income that later funds Social Security. But then guess what? When you retire, like I just said, up to 85% of that benefit can be taxable to you. In effect, this reduces the amount of monthly income that you're getting in retirement because of taxes. You're taxed when it goes in and you're taxed when it goes out. This double taxation, it really hurts a lot of retirees' spending ability. While this tax burden has been a long-standing challenge for retirees, there's now potential legislative movements that could fundamentally change this situation. So let's look at the Senior Citizens Tax Elimination Act, H.R. 1040. This bill could potentially eliminate taxes on Social Security, which could be a huge win for you in retirement. This bill has been introduced before, but due to support from multiple branches of government, it might actually get through this time. If this legislation passes, it could be in the next year to 2 years. However, there are political dynamics surrounding this legislation because getting rid of this tax would increase the deficit. But with other areas of government getting more efficient, it might make room for this to actually happen this time. And this change would help millions of Americans in retirement on a fixed budget. After analyzing the potential impact of the Senior Citizens Tax Elimination Act, I've identified specific financial benefits that vary dramatically based upon your income level, retirement amount structure, and overall tax situation. Understanding these nuances is critical for optimizing your retirement strategy, whether this legislation passes or not. We need to look at the tax savings. If this is passed on Social Security, you may not have to save as much for income for retirement. This could lower the overall amount that you have to save. Different income levels would experience different benefits. Higher income families would have more savings potential because Social Security is taxed at either 0, 50, or 85%. So what I mean by that, if you're a higher income earner and this tax is eliminated, you would get more overall tax savings with this. There are also immediate planning considerations for current retirees that you need to know about that I'll walk through in this video, such as where to save money and how to spend money. Also, this legislation might affect retirement timing decisions. If you have less tax to pay, you might actually be able to retire sooner than later. Now, if you want to further optimize your retirement plan, just click the first link in the description below to fill out a complimentary questionnaire. And after that, I'll send you a video breaking down exactly what you need to do to optimize your retirement plan. Let's look at exactly how Social Security benefits are currently taxed and who would benefit most if these taxes were eliminated. Here's a source that you can check out that's in the link below as well. Here's what you need to know. Your Social Security is taxed on what is referred to as provisional income. This is your gross income plus tax-free interest plus half your Social Security. The higher this number, the more Social Security tax that you pay. The laws have never changed to increase these limits. In fact, higher income earners will pay more taxes on their Social Security benefits. Specifically, researchers estimate that eliminating taxes on Social Security benefits would have the following effects. It would reduce the federal revenue by $1.5 trillion over 10 years. These are negative side effects, again, for the changes in the Social Security tax. It would increase the federal debt by 7% by 2054. It would accelerate the depletion of the Social Security Trust Fund by 1 year, from 2034 to 2033. And it would reduce average wages by 0.4% over 10 years and 1.8% by 2054. These are all negative impacts. While understanding these potential impacts are important, the uncertainty around if and when this is passed, it creates a huge planning challenge for retirees and those approaching retirement. The potential elimination of Social Security taxes creates a planning dilemma. Act now based on what might happen, or wait for certainty, but potentially miss valuable opportunities. This is exactly why understanding the fundamental planning principle is critical during legislative uncertainty like this. It's really tough to make decisions with pending legislation, because it might happen and it might not. Again, this planning dilemma creates an issue for a lot of retirees, but I'm advising you to be ready. And I'm going to give you things in this video to help you be proactive when it comes to your retirement planning. The key to effective planning during this legislative uncertainty isn't trying to predict the outcome. It's implementing what I call the resilient planning framework. This approach focuses on strategies that provide value, regardless of whether or not Social Security taxes are eliminated, while maintaining flexibility for you to capitalize on these changes if they occur. This is a solution that you need to implement so you're ready, that way you don't have to get ready. There is a problem with making financial decisions based upon pending legislation. If they don't happen, things could go wrong. The three principles that we use and that we teach are value-based sequencing, optional preservation, and scenario testing. Each principle applies specifically to the Social Security tax elimination uncertainty, and they each provide specific advantages during this tax uncertainty time. Implementing this framework doesn't require complex financial engineering. It requires the following specific steps that systematically apply these principles to your exact situation. These strategies work for retirees at any income level and can be implemented without making major financial commitments before the clarity emerges. Now that you understand when this could happen, let's analyze how you can optimize your plan based upon everything that I just talked to you about. Let's get into these actionable steps. Value-based sequencing. This is where you identify and prioritize retirement planning decisions that provide value regardless of what happens with the Social Security outcome. You need to use the money that you have to create value in your life. Optimizing your Social Security claiming strategy based upon longevity and spousal benefits is key to you. What I mean by this is you have to focus on these high impact decisions. What is going to matter the most? Because if you wait, every year you wait past your full retirement age, you get an 8% step up in your Social Security benefit. For couples, this is huge because the surviving spouse gets the higher of the two benefits. In addition to this Social Security optimization that you need to be doing, you need to implement basic tax diversification strategies into your plan that work well under either scenario. What we teach our clients is to create a waterfall of income from different sources, tax-free, taxable, and of course, Social Security. To optimize your tax strategy is what we're trying to get at here. You need to continue to focus on fundamental financial planning elements, like appropriate asset allocation and appropriate spending limits. Just if this tax changes, it doesn't allow you to overspend or to go all in on stocks. You still need to follow our Red Zone retirement planning principles. In my book, The Red Zone Retirement Plan, I talk extensively about this. Grab a copy on Amazon or email me if you'd like a complimentary copy. You need to avoid large, irreversible financial moves that only make sense if this legislation passes or fails. So don't commit to something before we know what's going to happen. Like I said, be ready. Instead, consider these smaller changes that we talked about. Increasing your Social Security outcomes. Incremental Roth conversions is a great thing that you need to be looking at. Obviously, maintain cash positions. 12 to 18 months is what we coach. Use temporary planning strategies that can be reversed or adjusted once these changes happen. In addition to that, it's very, very important that you document what you want to do so you're able to take quick action once these things pass or don't pass. Here's some mistakes that you want to avoid. Don't not do anything, so don't delay your planning until things change. You don't want to focus exclusively on the tax planning aspect while negating other things such as your long-term care protection, asset allocation. Do not assume this will pass as it's currently written, because changes will happen. So don't become emotionally invested either, because this can lead to negative outcomes. If followed properly, our clients, it's going to lead to this for them. It'll lead to minimal planning regret. It'll lead to optimal positioning from benefit standpoint. It'll lead to protection against them from adverse tax consequences. And it will honestly significantly reduce their anxiety. Just make sure that you are aware of these changes that are going to happen. Now that you've seen how the proposed elimination of taxes on Social Security benefits could potentially affect millions of retirees, with impacts varying dramatically based upon your income level and tax situation. If you'd like to learn how these potential Social Security tax strategies can affect your specific situation and how to create a resilient retirement strategy that works well regardless of what happens with this legislation, I've created a questionnaire that will help me provide personalized guidance to you. After completing this short assessment, you'll receive a video from me that walks through how these principles apply to your unique circumstances. In order to access it, just click the link in the description below, and I'll see you on the next one. This podcast is for educational purposes only and may include references to concepts that have legal and/or tax implications. It's not to be construed as legal or tax advice. Such information or opinions is subject to change without notice and is not intended to use as an offer or solicitation with respect to the purchase or sale of any security, insurance products, or offer of individual investment advice. Any strategies discussed may not be suitable for everyone. Mutual of Omaha Investor Services, Inc. does not provide legal or tax advice. Please consult with your appropriate professional regarding your personal situation prior to making any financial decisions. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Riser Insurance is not affiliated with Mutual of Omaha Investor Services. Investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Diversification does not guarantee a profit or protection lost against loss in a declining market. Purchase of life insurance is subject to meeting underwriting requirements. There is no guarantee of an individual will be insured. Annuities are long-term investments designed for retirement purposes. Withdrawals of taxable amounts are subject to income tax, and if taken prior to 59 and a half, a 10% federal penalty tax may apply. Guarantees are backed by the claims paying ability of the issuer and are subject to their terms and conditions.